Hey everybody, welcome to Trading Capital's sector analysis of all of the S&P 500 sectors. Today is currently January 28th as we dive into the charts. Before we analyze each sector of the S&P 500, we're going to look at the S&P 500 as a whole to really distinguish where we are in this market cycle. So clearly what most market participants are looking at is this potential breakout on the daily chart. Now, this is the weekly view of the S&P 500. So we haven't really confirmed a breakout on the weekly time frame, but on the daily time frame, you actually have confirmed a technical breakout. As seen on this chart, on Friday, you got a positive daily close above this key trend line that we have been really trading under for the last basically just 13 months coming up here. So really the major trend looks to be trying to break to the upside, but we have to be mindful of a couple things. And I'm not going to touch base on why I think this breakout is actually potentially more of a fake out, designing and luring more novice retail traders before they take the market slower. There's a few things that we will touch base on in this video that you really should be able to sum things up as to why we think the S&P 500 is not going to continue its bullish move to the upside, despite there being potentially a little bit more upside in the near term. Overall, if we look at the weekly chart, you can clearly see it's peaking above this key resistance line. If for some reason you get above this white trend line, this zone over here, you have this massive COVID QE trend at this white trend line here that would act as a secondary resistance level. Now, let's take a quick look at the XLK because it is the largest sector, and we'll proceed from the largest to the smallest weightings of the sector. So starting with XLK, the technology sector, obviously with the technologies, you also have a potential breakout out of this downsloping channel. Keep in mind that we are pretty much on a 1, 2, 3, 4, 5 week rally to the upside. So there hasn't been any consolidation on the weekly time frame, which means that you are overextended in the short term. And despite us potentially peaking out and breaking out of this major downtrend cycle, what we have to keep in mind is we're still trading inside of this weekly hammer reversal candle up until we actually confirm and close above this key level. The S&P 500 really hasn't broken out in my opinion because we're still stuck under this reversal candle. So obviously with technology being the heaviest weighted sector, we have to continue to monitor the mega caps like Apple, Google, Microsoft. Obviously, we still have Apple set yet to perform next or set to release their earnings next week. So that will be a market mover, being its market cap is over 2 trillion deep. Looking at healthcare is very concerning because typically at the early stages of the bear market, healthcare starts to underperform, as well as precious metals and energy start to outperform. So when you have the precious metals outperforming as well as energy outperforming, and then you have healthcare weakening and actually putting in this bearish pattern that's looking like it would trigger any week now, it does leave this market very vulnerable to seeing continued downside, especially being the fact that healthcare represents a weighting in the S&P of about 14%, 7.73 trillion. It is the second largest sector. So if we take a look at the next sector, we can see that XLY, so that is consumer discretionary. So XLY, we've been watching this interestingly for quite a long time because we were aware of this original bear flag breakdown, which actually did trigger, but you did not confirm on the larger time frame, the weekly chart. So despite confirming on the daily, you actually reversed on the weekly. And this is kind of what we could be seeing the inverse in happening in the S&P 500. Being the fact that we did confirm on the daily, most market participants would have went net short on this XLY ETF. But then since you didn't confirm on the larger time frame, the weekly chart, it had an epic and mean reversal right back to the upper range of this channel. And you can see that we're right trading inside of the upper range of this channel. And whether or not we get through it ceases to remain. But being the fact that you've had a pretty large rally from 126 to 147, it will likely take a little bit of downward consolidation before we can yet to resume an uptrend, if the markets are trying to resume an uptrend. But I do think that it's very limited, the upside for XLY. In terms of where I think we could see the XLY push up to, if you take a trend line from the COVID low all the way to your summer pivot low in June, intersecting with all of this weekly chop before you broke down, you can see that there's potentially a little bit more upside to the 150, 150 level. And that would really be a massive, massive level, especially if XLY push straight into that level without any consolidation. My expectations for XLY is to probably just continue to chop in the sideways range until we eventually look to test the double low or break this key yellow trend line and looking to potentially go lower on the charts. Let's flip to the next sector, which is communications. So communications is pretty important because it's one of the sectors that has broken out on a technical basis. If you simply take a trend line which tracks your basically your 12-month downtrend, you can clearly see on the weekly time frame the XLC communication sector has broken out and confirmed. Now, the importance of this is the fact that communications is one of the most beaten down sectors, and it doesn't hold as much weighting as healthcare and technology. Although it does hold a larger rating than most, it still really is about in the middle of the packs. And being the fact that it was the most beaten down and oversold heading into 2023, it makes sense that it would have the largest mean reversion technical bounce to the upside. Couple key levels on the XLY. Obviously, you can see here you're on a 1, 2, 3, 4, 5, 6 week candle time count, and that is obviously overbought in the short term. And you can naturally see that you're coming into this COVID trend line, this pre-COVID high before you had your massive collapse on the weekly chart here. So naturally, this level is going to be big resistance. Obviously, buyers that got out over here will likely continue to sell. And being the fact that we're still in a quantitative tightening area, it finds it very hard to believe that we can replicate any sort of gains as we saw here in 2020 and 2021 without any mass stimulus of global and economic policy. So until we see mass stimulus occurring globally, it's unlikely that we resume any upward trend like we saw in 2020 and 2021. Let's take a look at XLF. XLF is interesting because XLF is still stuck under weekly resistance. If you simply take your pivot low over here, your pivot low over here, this was your breakdown zone. So you had your hard sell off, which was your initial adjustment for the market adjusting to the higher rates. And basically, this is where you triggered your breakdown in this little bit of a topping formation. And you've now only naturally retraced to the breakdown zone. You can see you retraced once over here, another time over here, a third time over here, and finally a fourth time over here. The big question is, can the XLF financials get through this level? Obviously, there have been mixed results in the bank earnings, being the fact that last week we saw a variety of companies report stellar earnings, which got big pops, but then there were also the likes that also reported really, really terrible earnings. So it's a mixed basket, but until we see XLF get above this key trend line, it remains to be seen that the spiders can't really have a true breakout to the upside. XLI is also an intriguing chart over here because you can see that you're trading at the upper range of this wedge pattern. XLI is still trading inside of this weekly hammer candle. Remember, we did get lots of volume. And being the fact that if you just naturally observe this candle size, the high to the low, it's a much larger wide range candle and it had a decent amount of volume. But when you look at this last weekly candle over here, it's a much smaller body candle, but it has an even larger amount of shares that were traded compared to this level over here. What this is telling us is that although there was a lot of buying pressure that week, being the fact that it was light volume, XLI actually was met with a decent amount of selling pressure, being the fact that volume was very, very high and the candle size itself is actually relatively small in comparison to the amount of volume that it traded, which tells us that although equal amounts of buying pressure were coming in, there were a lot of sellers distributing at the high of the chart. So let's keep in mind that XLI has been one of those market performers that really hasn't seen too much downside, and it's really been strong, the major of its trend. It looks to be as if it's putting in bullish consolidation. I've heard a lot of analysts say that this type of pattern is bullish, but when you start seeing this massive chop, breakdown, and retrace, another breakdown, this choppy price action near the highs of the charts with massive volume distribution is certainly not healthy from a trader's perspective. Let's take a look at the XLP, so consumer staples. Consumer staples is important to watch. The likes of Costco and Walmart are key indicators to the economy. Obviously, with Walmart being the second largest, or sorry, the largest employer in America, you have to naturally follow and observe what they are telling us. You know, they've recently announced that they're raising their minimum wage, which naturally is inflationary in the overall economy. And then we've also found out that they have announced some layoffs. So there's a lot of mixed signals that are occurring from a lot of these important companies. That's why we look at these sectors. The sectors really break it down and give us a clear perspective. On the daily chart, you are forming a wedge pattern. On the weekly chart, you've broken out of this key consolidation and you're now at support as seen by this potential trend line here and these pivots over here. The thing about this level is that considering you were consolidating bullishly, but now you've broken down, what we're waiting for is, can you get some sort of a consolidation in bearish fashion along this level before you break down? That's kind of my expectations for consumer staples. It likely will see potentially another few more days or maybe a week or two of consolidation before making a next move to either the upside or the downside. But this pattern does typically favor more downside price action. You can naturally see that we've just been chopping in this parallel range. Price action loves to move in symmetry. There's something about symmetry in the human race that we find very appealing. So price action really moves in symmetry, and it's very intriguing to watch because you can easily chart a high pivot, low pivot, and just play the upper range by going short, the lower range by going long. But the fact that we've hit now once and twice on the lower boundary range, the next time we do come down into this level, it does open up a little bit of risk that this range, this bottom of this range can break and we could even trade lower. Now, it really matters how quickly it comes into this level. So we're looking for a rate of change movement that is going to dictate how strong this support level is. And that's kind of what we're watching for. Let's take a look at XLU. So utilities are the next sector in the index, but you can naturally see as well the utility sector put in this weekly hammer several weeks ago, which we touched based on. Obviously, you can see that hammer happened on a heavy amount of volume, 71.81 million shares. And we haven't been able to confirm above that pivot for now 1, 2, 3, 4, 5, 6 weeks. Next week will be the 7th week. And what's intriguing about this level is that, again, you're trading at this support level. But if you simply actually draw a trend line from this major pivot over here in June, you can see that this COVID trend line over here, once again, you've never confirmed above it. And it looks to be that you're breaking down and trying to put in weekly confirmation to the downside. Now, what I'm watching for utilities for another market signal is if we confirm next week below these pivots, you've now confirmed a technical breakdown on the weekly chart in utilities, and it likely sends you to the lower range of this channel that probably would correlate somewhere around the 55, 56 level. You can see that we have massive consolidation in and around this area before breaking up, testing your pre-COVID high, rejecting, coming back down, consolidating, and then pushing up again. So again, next week for utilities is very, very important because it is on watch for a technical confirmed breakdown if you break this key pivot over here around the 67.85 level. Let's take a look at real estate, XLRE. Obviously, with yield softening, you've seen real estate really take advantage of the softening interest rates, and it's trying to push up. XLRE is at resistance, but for the short-term positive for XLRE is you have actually confirmed above this pre-COVID high. So the fact that you've actually captured this pre-COVID high on a weekly basis does leave real estate the option to potentially move a little bit higher. Now, I'm not saying it's going to. I'm not going to put my bets on real estate moving higher because you are trading at resistance, but there is a potential that you could break through this first resistance and head to the second resistance around this pivot around 42.41. And naturally, that would actually be a very, very healthy retrace. You can see that the major breakdown occurred right around here where you teetered, you didn't confirm, you tried recapturing this key trend line over here, and then you actually failed, broke down, reconfirmed the breakdown, had a technical bounce off of your COVID trend line, and then you recaptured that breakdown trend over here on this white trend line, confirmed above, but the fact that the confirmation did not hold up the following week sent you trading much, much lower. So again, there's a lot of moving dynamics with real estate. There is this weekly hammer candle that you have closed above on a weekly basis. So now the fact that can real estate make a secondary close above this level? If it can, you likely will see real estate, the XLRE, trade up to this 42.65 level. And that would probably be about let me just measure that out, around a 5% rally. So not too much more upside when you factor in that we're pushing back up almost to the near highs of the chart. And then when you factor in how much risk to reward to the downside there is, it doesn't make a favorable setup to trace this on the long side. Maybe if you were picking it up down here at 32.95, that would have been a good risk to reward setup, but it certainly does not provide an opportunistic setup, at least one that we would play. Let's take it, and real estate is heavily tied to the interest rates environment. If Powell comes in and raises interest rates, which he's set to on Wednesday, that's naturally going to spike yields, which would put pressure on the real estate sector, and you would likely see it sell off. Now, I'm in the camp that the bond market has it wrong. We are seeing the 2 year yield not pricing in a Federal Reserve hike on Wednesday. Just like the bond market was wrong in 2022, I think the bond market is wrong in 2023 as well. There's a lot of stigma saying that the bond market is the smartest money. Well, it certainly wasn't the smartest money when interest rates started skyrocketing. There were trillions and trillions of dollars lost worldwide. So I'm finding it very hard to believe that the bond market is getting this signal right when the Fed is telling us that they're point blank raising rates and there's about a 7% discrepancy in the current rate environment. So that is a little bit of arbitrage opportunity for us to try to capture next week. If the Fed does raise rates, the bond market have it wrong. Assets will be severely priced, most likely falling to the downside. XLB is an interesting sector. Oh, that's the wrong chart. My apologies. XLB is interesting once again. What's the common theme? Trading right under resistance in an extended move. So without XLB breaking out, this is another sector that we have to continue to watch. It's trading inside of this weekly hammer reversal, which we touched base on about 6 weeks ago. But until you confirm on a weekly basis above this key level, XLB remains at resistance and it remains vulnerable to seeing downside pressure. Finally, energy. We have to touch base on energy because there's a lot of energy bulls out there, and we have to cater towards all of the asset classes. And energy is intriguing because obviously it is the smallest weighted sector, so it really doesn't move the S&P that much. But the energy bulls have such high conviction that it really is a good sentiment indicator for the overall economy. Most energy bulls are holding their net longs up until, the day that they die. So if we start seeing the energy sector sell off, that is really showing the sentiment of the most hardcore bullish people starting to capitulate and sell their investments. So energy, if you notice how energy has had 1, 2, 3, 4, 5, 6, 7 weeks of continuous straight upside, and it's all trading inside of this wide range red bar sell off. We have not confirmed and been able to break out of this wide range red bar for 7 weeks straight. So basically, to put into perspective, you could have had 7 weeks of brand new fresh buyers buying up this energy price thinking it's going to break out. Meanwhile, you're trading at the top of a multi-year wedge pattern that you have a pivot high going all the way from 2014. You have a pivot high going all the way to the crisis of 2008. So when you have a trend line that has a length of about 12 to 14 years, depending on where you're taking it from, a 12 to 14-year trend does not break very easily, and it does not break when you've had 7 consecutive weeks of upside heading straight into that weekly resistance. There's a reason this trend line has acted as resistance for more than a decade, and it's more than likely going to continue to act as resistance in the near term, especially when you factor in the real discrepancy between energy and the overall underlying assets that they're priced in. If you look at natural gas, if you look at oil, they have been demolished, and it certainly doesn't favor the profit margins to be priced in at the current valuations that they're pricing. I mean, natural gas has had a fall from grace like you cannot believe. Even if you look at oil's trading around just under $80, stuck at key resistance. So it really doesn't favor these energy stocks to continue to move up as the assets of oil and natural gas continue to move lower. Now, natural gas, we're expected for a potential bounce. That's where we're positioned. But even still, when natural gas has a fall from the $11 it was trading at all the way down to about $3, that is a mighty, mighty fall. And I don't think investors have really repriced the energy stocks assets. And just a little bit of history and cycle analysis. If you look at Chevron's one of the leading energy stocks. They reported earnings and they actually missed on their earnings. One of the reasons their stock was up this week was because the fact that they announced a share buyback of, I believe, 75 billion. Typically, if you look through market cycles in history, and I've been doing this for about 10 years, you'll see that companies tend to buy their shares back at the highs of the charts. You saw it with Facebook, Meta. They always seem to buy and repurchase their shares at the highs of the chart. So to sum things up, most of the indices are trading at resistance, which is why I'm skeptical of this breakout. And if you want to find out more information, other factors as to why this breakout is likely not to happen, subscribe to our channel below and share our information. Take care, everybody, and we'll see you in the chart.